Occurrence of corporate scandals.
Public trust in corporations has been severely compromised even though over 90% of Fortune 500 companies have ethical codes of conduct reminding their employees and stakeholders of their shared beliefs and values, and indicating the responsibilities and behaviors expected of them by their respective employers. 11 Widespread declaration of codes of conduct by corporations imply that corporate managers are aware of appropriate ethical behavior and societal expectations. Even though trust is an essential element of business transactions, ethical breach of trust is a commonplace phenomenon, seen worldwide. Failure on the part of corporate executives to meet their responsibilities to stakeholders suggests a lack of understanding of the gravity of the situation. As stated by Dhir, it is imperative that executives in industry and corporations, senior executives in particular, take to heart the lessons learned from recent corporate scandals of unprecedented scale and audacity. On these executives lies greater responsibility today than ever before to meet societal expectations of ethical conduct. 12. Corporate greed and managerial self-interest have manifested in major scandals, bringing highly regarded companies to disrepute. A few cases are described to provide a sense of the audacity and scale of these scandals. Enron, a global company in the business of trading and marketing natural gas and electric power, disguised debts from failed projects through accounting loopholes and questionable reporting. Their purpose was to mislead investors and unethically project the company as one that held great promise. Through the 1990s, Enron's stock price increased by 311% to give the company a market capitalization of $63.4 billion. 6 times its book value! 13 However, a whistleblower, Sharon S. Watkins, Enron's vice president for corporate development, exposed Enron's corporate culture of fraud, and the house of cards came crumbling down. 14 Investors lost nearly $90 billion when Enron's stock prices dropped from about $90 per share to about $1 per share through 2001.15. Ultimately, Enron declared bankruptcy and ceased to exist. The scandal raised questions about the role played by Enron's audit and accounting partner, the erstwhile highly reputable Arthur Andersen. The colossal failure of Arthur Andersen's auditors to appropriately report on Enron destroyed its reputation and led to its dissolution. Arthur Andersen was charged with and found guilty of obstruction of justice for destroying records after investigations into Enron had begun. 16 The scandal also raised questions about the appropriateness of allowing auditors to also serve as consultants to their audit clients. Calls were made for the regulation of large accounting firms. It was argued that Arthur Andersen was at best lax in auditing Enron because it got larger fees from consulting for Enron than auditing the company's books. 17. Enron's bankruptcy was the largest corporate bankruptcy in U.S. history, until WorldCom broke the record the following year. The WorldCom scandal was also rooted in accounting irregularities. The company's growth had been sustained through mergers and acquisitions. When WorldCom merged with MCI Communications in 1998, the $37 billion merger was the largest ever in the United States. In 2000, when the telecommunications industry experienced a downturn, WorldCom CEO Bernard Ebbers was under pressure to cover margin calls on his WorldCom stock that he had used to finance other businesses. He took loans in excess of $400 million from WorldCom to cover the calls, putting the company under further pressure. Under the direction of Ebbers and other officers, the company deployed fraudulent accounting practices to underreport costs and inflate revenues, thereby hiding declining earnings and projecting a false picture of growth and profitability. Subsequent investigation revealed that the value of WorldCom's total assets had been inflated by around $11 billion. 18 In 2005, Ebbers was sentenced to 25 years in prison for securities fraud, conspiracy and filing false documents with regulators. 19. In his 2012 State of the Union address, President Barack Obama called on the U.S. Congress to toughen the laws against securities fraud and to strengthen the ability of the Securities and Exchange Commission to punish Wall Street firms that repeatedly violate anti-fraud statutes. 20. Examples of large-scale corporate scandals are not isolated to the United States. Based in Switzerland, Azia Brown Brewery, ABB, describes itself as a global leader in power and automation technologies that enable utility and industry customers to improve their performance while lowering environmental impact. 21. It was created through a giant merger of companies in the Swiss, German and Swedish heavy industry sectors in 1988. Its market capitalization soared eightfold and was valued at $25 billion by February 2000. However, the company turned out not to be the earnings juggernaut it was made out to be. Just a year later, it was discovered that about 28% of reported net income between 1998 and 2000 was actually from non-operating sources such as property and business disposals. This was not an isolated incident. It came to light in 2002 that the erstwhile CEO, Percy Barnevik, had been paid an undisclosed severance package of $78 million without the knowledge of ABB's board of directors. 22 In 2007, ABB admitted to have violated the U.S. Foreign Corrupt Practices Act's FCPA, anti-bribery law with questionable payments in Asia, South America, and Europe, with a particular focus on Italy. 23.